When you design the right retirement plan for any small business and any pass-through entity, you want to look at the right plan for the owner, but also the employees. And the makeup of the employees sometimes will determine the best structure of the retirement plan that you want to use for the owners. For instance, if you have a much older employee base, defined benefit plan may not be the type of plan you want to implement. It might be more of a 401k or profit sharing plan. The other thing you want to think about is a pre-tax plan, which is a deductible plan, versus say a Roth type plans. And in some cases you can implement both. Now, Roth is not a tax deductible item, but it does grow tax-free. And then when you pull it out, it's all tax-free too. But sometimes in some of these plan designs, you can add both. You can have a Roth component and then you can have a pre-tax component. And then when and how to fund these type of things. One of the benefits of retirement plans in a small business is if you file an extension with the tax return for the business, you can extend the payment of funding that pension plan until the due date of your return. So for many small businesses, it also gives flexibility in that we can take the deduction and then you can pay it at the time the extended tax return is filed. So it adds some flexibility and also gives you some cash flow relief. Using the pass-through entity tax to your advantage. First of all, what is it? Back in 2017, we had a tax bill, the Tax Cuts and Jobs Act of 2017, which restricted the state and local income tax deduction for individuals at $10,000 per. The issue with that is for many small businesses, when they pay state income tax, well, that number capped that as well. However, if you have a pass-through entity, depending on what state you live in, you can actually pay your state income taxes out of the entity, which directly reduces your federal taxable income. Thus, you get to circumvent the entire $10,000 cap. So it's a great way to actually reduce your income taxes that way. The other thing to think about is when you have a pass-through entity, again, these are things like S corporations and partnerships, for example, you want to make sure you do year-end planning. And the reason for that is when you pay your state taxes throughout the year, and you're going to pay them quarterly, for instance, if you have, say, a big year or you have a lot more profits than you thought, you want to know that number before year end and actually make an accelerated fourth quarter payment prior to 12/31, so you can pick up that federal deduction during that calendar year. Now, there's other considerations like, timing and, maybe your subsequent year is going to be even higher. So you have to think through all these other factors, but the timing of that could be important. So just keep that in mind as you're paying your tax bill. The qualified business income tax deduction. What is it? It came out of the 2017 Tax Cuts and Jobs Act. It's basically a deduction, a free deduction, think of it that way, that allows a tax cut for small business, pass-through companies, S corporations, partnerships, things like that. That is roughly 20% of the net income of the company. Now, there's other limitations and things like that you want to make sure you go through with your CPA, but it's roughly in the ballpark of 20%, which, as you can imagine, that's a pretty substantial deduction. So when you're planning your year and you're planning your tax planning, you want to take into account, we call this QBI, it's called Section 199. You want to take this into account when you're doing your planning. It might mean that you look at your structure and how you're structured. It might mean you see how your W-2 wages are, and there's some planning around surrounding that. This is also where voting matters in the legislature. Currently, under the Republican Congress and President Trump, this particular bill, they're working on extending it past 2025. Had a different political party came into power in November of 2024, and obviously, January of 2025. That particular deduction was likely going to go away. So this is where voting matters directly in the pocketbook, and this particular deduction was relatively substantial and still is for small business. So as you plan for 2025 year end, be sure to take this one into account. The importance of good accounting records. From a tax standpoint, every situation I've ever seen where the client has poor accounting records, almost guarantee they've overpaid income taxes. You want to make sure that during the year, you have accurate information going in, which means you get accurate information going out. So as your company progresses throughout the year, you not only want that from a tax standpoint, but you want that from an operational standpoint. So that every month you can not only see how you're doing, you can compare to prior year, you can see why something is up, why something is down. And that also helps your accountant when they're analyzing the financial statements say, why is this way? Or why is this that way? That doesn't make sense. And if you put something in a wrong account, it allows the accountant to properly pick it up, and maybe there's a credit there or something extra from a tax code standpoint that we would never be able to find if the records are in poor shape. So that's a really important reason to do that. The other reason is, should the IRS ever challenge your tax return, you want to be able to have good, accurate records to pull up and prepare. They can actually slap you a fine if your records are poor record keeping for a business. So you want to make sure you keep those things contemporaneous, meaning current during the year, and then hopefully you won't have any issues.